podcast with us today is Charles Seaman. Charles, welcome to the podcast.
Dan, it's a pleasure to be here. Thank you very much for having me.
Well, I'd love for you, Charles, to get us started and give us a little bit of a background about yourself and where you are with the multifamily side of things. And right before we dive into this property you guys acquired in December 21st of 2020. So it's pretty fresh. We're talking about this in the middle of January 2021. So you haven't even owned that property for 4 weeks yet, for a month. And so it's going to be really fresh on your mind. I love being able to interview folks that have acquired properties that close to their acquisition time frame. This one's located in Sumter, South Carolina. So I'm going to turn it over to you, let you take it away, give us a little bit about your background, and we'll dive into this acquisition.
Yes, absolutely. So I originally started working for a successful commercial real estate investor in New York City in 2005. And I was very fortunate to learn a lot from him during the 14-year tenure I had there. So from that point, he had several different businesses and properties between commercial real estate, a plumbing company, and different bars and restaurants. And my role there eventually expanded to help him manage all of his different properties and businesses. And for me, I always gravitated more to the real estate side just because I personally enjoy it much more. And it was something I knew that I eventually wanted to do. For myself, I had started there fairly low level, worked my way up, and my intent was to stay there 2 or 3 years. And then I probably got a little bit too comfortable as I started doing better for myself and stood 14. Lo and behold, fast forward to 2017, I decided at that time to start working on the syndication business in my spare time, initially putting in 10 to 15 hours a week. And then from that point in May of 2019, I decided, you know what, let me go all in with this. Because if I don't, I'm going to take too long to get the results that I want. And I need to just make the plunge and go for it. So from that point, I left my full-time job and I relocated to Charlotte, which is really at the heart of our target market. For myself and my team, we focus in the Carolinas primarily, and throughout the Southeast and other areas, we're really in the Carolinas. So Charlotte's where we're based out of. So I said, how do you get to know the target market better than living and working in it? And I decided to put myself right in the center of it. And fast forward now, and that's kind of where we are.
Awesome. Well, I'd love for you to go ahead and get us started on this acquisition here, located over in Sumter, South Carolina, not necessarily Charlotte. You could kind of talk a little bit about where Sumter is located once we dive into this a little bit. But this one's called Waterford Place Apartments, 48 units. And you guys closed, like I said earlier, in December 21st, 2020. So let's dive into this and talk to us about how you found and sourced this deal.
Sure. So one quick thing, Dan, it was actually September 21st, not December. So on this one here, we actually got through a broker relationship and it came as an off-market deal. So initially we had lunch with the broker in January 2020, and he had asked us if we were interested in potentially having a deal in Sumter. And my initial response, similar to probably many on here, is where's Sumter? So I initially had a look and say, where is it? And really research the metrics. So the deal itself underwrote pretty well. My concern initially was the area. So I said, okay, let's go down there, let's drive it, and let's really make sure we're confident in it before we move forward. So it was one of those things that if we hadn't seen it in person, we probably would have been a little more reluctant to move forward with it. But after we drove the property and drove the area, we said, you know what, there is decent traffic here and the property is located probably in the best section of the city. So overall, I think we have solid location, decent vehicular traffic, and a nice little, tertiary market that seems to be, fairly bustling for a tertiary market. So at that point, we submitted an offer and we went, back and forth a little bit with the seller and negotiated. And then we came to a price and signed the contract mid-February. Ironically, one of the keys to this is that at that point, the property was only 75% occupied physically, which for 48 units is a lot of vacant units. And the reason for that is because the seller was a local family and they've owned the property for about 5 years, and their management company hadn't been very proactive with the way they were marketing it. Believe it or not, in 2020, they were still using the print version of the newspaper as their primary marketing source.
Wow. Wow. For apartments.
Yes. So that gave us some opportunity because we realized, okay, you know what, all we really have to do is improve the operations, and we have the ability, one, to stabilize the property, And the second thing is, in addition to having so many vacant units, the units that were occupied were significantly below what similar properties in the area were getting. So this property was built in two separate phases, one phase in 95, the second phase in 99. And we realized, you know what? The rents were between $575 and $650 when we first started looking at it. And we realized that similar properties in that area were renting for $750 to $850. So we felt very confident that based on the comps we'd seen, $750 should be at the bare minimum a realistic, achievable number we can hit. So then we decided to move forward and go from there.
And when you submitted that offer, what kind of was there any type of hard money day one or after due diligence or anything like that you had to put on this contract?
No. So one of the benefits to off-market deals, and in particular to deals of this size, where you're dealing with, like in the 50 to 100 unit space, a lot of times you won't have as much hard money. So the seller didn't ask, so we didn't offer.
Yeah, that's good. And was this a completely off-market acquisition?
Yeah, so there was probably two or three other groups looking at it, but we had an advantage because we were local, being in Charlotte, just an hour and a half away, where some of the other groups were in different parts of the country, so they weren't able to move on it as fast as we were.
Yeah. So you being able to be local in the market, pounce on it pretty quickly, get a good understanding of it, it allows you to have a little bit of a leg up on the other two buyers that were kind of looking at it.
Correct. Yep.
That's great. What did you end up buying it for?
So we wound up getting it under contract initially for $2,550,000, but then we wound up getting a slight credit because of COVID, and we got a $75,000 discount and wound up closing at $2,475,000.
Okay. That's great. Well, I'm sure we'll talk about that a little bit as well as we move forward into this, because it sounds to me like there's probably some interesting things that went on to be able to over the last year in 2020 that we can kind of dive into. Mm-hmm. Let's talk a little bit about whenever you actually put this deal under contract, how much time in the contract did you leave yourself for due diligence and potentially maybe even some extensions that were added on as well?
So we gave ourselves 30 days for due diligence, 30 days to close, and 30 days for an extension. So keep in mind, we initially signed the contract mid-February. Everything was still pretty normal at that point. It seems so long ago at this point. But then lo and behold, in the next 30 days, things would change substantially. And with that deal being it wasn't stabilized, we initially looked at it as a bridge play, which the bridge market temporarily, for the large part, really shut down starting in mid-March.
Yeah, and once mid-March hit, that's when it started. The debt market started to change. The 10-year treasury dropped, and the bottom fell out of the market, and it was definitely a challenging time in this particular market. So obviously, you went through the due diligence process, and before we dive into what happened with the debt side of it, let's talk about anything that came up during that initial phase of due diligence.
So one thing we liked about the property is that physically it was in pretty good condition. With every property, you're always going to have some issues, and we always like to bring professionals with us. So we usually walk between our team. We usually walk all the units anyway, but we'll also bring our property manager. We always have a structural engineer with us, and then a few different professionals just to make sure things are in good condition. So the structural engineer overall came back with a fairly clean report. There was one building that did have some minor settling, and we did need to have helical piers installed on it to mitigate that any further. We had a roofer go out there and also assess the condition of the roofs and the gutters. But again, nothing out of the ordinary. I mean, there was some work that's needed with any property, but overall, we really wound up with a CapEx budget less than $100,000. So we wound up inflating it to make sure we had at least $100,000, and then we always have a reserve on top of that. But the reality is there's fairly minimal CapEx and minimal deferred maintenance. So that was one of the things we really liked about the property.
Now, obviously being built in two phases in 95 as well as 99, sounds to me like the roofs would have been pretty close to their end of life unless they've been replaced recently. Yeah,
so 3 of them had actually been replaced within the last 5 years, right around the time the seller purchased the property. So that was good. And the other 3, we did wind up budgeting for, because that was actually one of the items we figured at some point we're probably going to need to replace them.
Mm-hmm. Good. So talk to me a little bit about after you got it under due diligence. Now we're into that end of the due diligence period. That's probably right around the time COVID really started to make a kind of a craziness or kind of raise its crazy head, if you will. So talk to us about what happened during that time frame, from the time that due diligence started to expire, and then of course the lending environment going kind of haywire.
Sure. So one thing that benefited us is that the seller took their time to get us the documentation that they needed to as part of our financial due diligence. And one thing we always do in our contracts is we negotiate it where the contingency period does not start until we receive all the documents that they're supposed to provide us with. So that gave us a few extra days, and that kind of worked out well. Lo and behold, our due diligence would have ended somewhere around April 3rd. And around St. Patrick's Day, I got a call from our mortgage broker, and he said, you know what? We were initially going with the bridge lender, and he said, listen, the bridge lender pulled the plug on it, not just on your deal, but they're shutting down their entire bridge program temporarily just to see what happens with the overall market. I said, okay, understood. So they refunded our loan application fee. And then at that point, I discussed with my team, and I said, well, we have to make a decision. Do we like this deal enough that we're willing to take a chance and see what happens and see if the market rebounds? Or do we just want to terminate the contract and get our EMD money back before it goes hard? So after mulling it over, we decided that we liked the deal, we liked the area, and we felt that it was clean. So we went back to the broker and said, listen, we'll put the ball in the seller's court and give them a choice. We'd like to work with them, and we'd like to see if we can work through this. But obviously, we don't want our money to go hard just yet because we don't know what's going to happen with the overall market at this point. So I said, let's come up with a few different options. I said, option one, if the seller wants, we're glad just to terminate the contract and we can both move on and shake hands and part ways. Option two is we can negotiate some type of extension for the due diligence period, which seemed to happen with a lot of deals that were under contract pre-COVID and actually closed. And then we gave them some different variations of that. But ultimately, the seller decided that even if we terminated the contract, they'd probably have the same problem with any other buyer that was coming in unless they were paying all cash for it. So they worked with us and they said, okay, let's extend the due diligence. They gave us 60 days. And that was, even though our physical and financial due diligence were really done and everything had checked out, the sole purpose of that was just to buy some time and see what happened with the overall market. So that pushed us back from the point we worked it out. It was late March, and that gave us until late May. So then at that point, the market had started to rebound a bit in May. Now, one really good thing happened during the lockdown, which surprised me. And it's perhaps a sign that their property management company hadn't been as vigilant as they should have been prior to that, but they actually stabilized occupancy at the property during the lockdown. And as of about May 1st, the property was stabilized. So initially, even in early to mid-May, there was still a lot of bridge lenders that, were still shut down. And there was some that were coming back online, but most mortgage brokers I was dealing with were telling me that even though they say they're lending, the brokers would tell me off the record that it's probably the lowest level of certainty they've ever had since they've been in the industry. So I said, okay, that's reassuring. So I said, let's make a decision and decide what we'll do. So we said, okay, the property became stabilized. So we got really lucky. And then we decided, let's go for agency debt. So I said, at least Fannie and Freddie are still backing loans. So as long as that's happening, we'll be in good shape. So initially we submitted an application in mid-May with one lender for a Fannie Mae loan. And on their term sheet, they had given us 75% LTV. They had given us a favorable interest rate, a year of interest only. And lo and behold, about 2 months, a month and a half later, because we decided to move forward, and then we also used our 30-day extension, the lender had done their due diligence. They came in with the appraisal about $200,000 higher than the purchase price. So that was good. Overall, they were happy with everything they had looked at. And finally, mid-July, and they came out with the commitment letter. And all of a sudden, the mortgage broker calls me and says, listen, they're not going to give you 75%. They're only going to give 65%. And I said, well, how did that happen? I said, they were happy. The property appraised well. We haven't heard of any indication that anything else went awry with it. I said, so what was it that caused the change? And how come they didn't have any inkling this would happen beforehand? and still to this day, I don't have an answer to that. But I just attribute it maybe to overall hesitancy with the market and just a lot of uncertainty at that point. So then at that point, we were supposed to close in the next 2 or 3 weeks because that was the end of our 30-day extension. And we decided that we just didn't want to go through with that because if we did, the 65% LTV would have hurt our returns too much. So we decided to bring the deal to a different lender, and we submitted with a different lender for another Fannie Mae loan application. And we told them right from the get-go, it was a lender that one of my partners had dealt with before. And we explained the scenario to them. We said, this is what happened with the previous lender. As far as we know, there's nothing drastic wrong with the application. The property appraised very well. So we wanted to be upfront with them so they knew what to expect. And that way we didn't waste, their time or our time or another application fee. So they were working with us as fastly as they could. We wound up negotiating another extension with the seller. And, thankfully the seller was very reasonable, and it only cost us another immediately hard deposit, but no additional money on top of the purchase price. So that was great. And then lo and behold, after another month and a half, the lender approved the application. We locked the rate and we said, well, good, we're finally ready to close. So I joke around and I say, for 3 lenders and 7 months, it probably took just about as much time as it's ever taken anybody to close a 48-unit deal.
Well, I'll tell you, I've seen a lot of stories on this podcast about various people and how long it takes. And it can definitely take some time. I've seen them take years to be able to get some of these deals closed, depending on kind of some of the different nuances and things like that. So a couple of questions for you, because there's a lot to unpack here. Mm-hmm. So first off, how much earnest money deposit did you have to put down from the very beginning?
Sure. So we put 1% of the purchase price. So the initial price was $2,550,000 and we had put $25,500.
Okay. And then did you ever consider or have the conversations about doing seller financing with the seller?
We didn't. It probably would be something good to approach, especially with this size deal when you're dealing with the local family that owns it, but it wasn't. We knew from the get-go they were looking to do a 1031 exchange. So we figured that they probably wanted that money because we knew they had a new development deal lined up behind it.
Mm-hmm. And what about any type of lender COVID reserves? Was there any of that at play on this property?
There was. So initially when we first started looking at it, that was a non-factor. But then as we went on, and especially as we went through agency debt, initially we were budgeting for 24 months of principal and interest. So I was glad to see that the reserve did drop a little bit before closing. And we wound up closing at 18 months of principal and interest on it.
And one of the other questions I had, which you talked about it a little bit when you talked about the other lender, is did you lose any of your app fees, or is it because when you jumped from one Fannie Mae lender to the other one, is that what allowed you to not have to lose the application fees?
So unfortunately, we definitely lost the application fee, and we just built that into the cost of doing business. And we said, well, we'll have to absorb that and just move on, because at that point, it was more important to, 1, to get the deal closed, and 2, to salvage our reputation and make sure we got it closed.
So walk me through how that process works when you jump from one Fannie Mae lender to another one.
Sure. So initially we went through a mortgage broker, and everything seemed to be going very smooth with it. We paid the application fee up front. The lender started working through their due diligence. They did their third-party inspections, and this is late May. So the appraisal was done probably by the second week of June. They had all the reports in hand, definitely by mid-June, and they were still mulling it over for a bit longer after that. So finally in mid-July, almost 2 months after they initially got the application and we paid the fee, they came back and they were ready to issue the commitment, and that's when we found out there was an issue. I was so, well, that would have been nice to know that's a little bit sooner in the game. So then at that point, internally with our team, we mulled it over and we said, well, what are we going to do? We could accept the 65 and just go ahead and raise the additional equity. But the biggest negative to that is that it would have impacted our returns in a way that we said it probably wouldn't make our investors want to invest with us as much or at all. So we decided let's try with a different lender. And one of our partners had already dealt with this particular lender. So we had a relationship with them directly. We weren't going through a mortgage broker. And we said, okay, let's bring it to them. And that's why we wanted to be very transparent and very upfront with our experience with the other Fannie Mae loan application. So that way we said, listen, if it's going to be the same thing, there's no point in us paying an additional application fee and you guys wasting your time on it. Let us know upfront. If you think that that's the best we're going to do, then that's all we can do. And we either have to make a decision that we want to accept 65% or move on. So they spent about a day and they got back to us pretty quick because we did express the urgency of the situation to them. And they reviewed it and they said they thought they could fund it. They wouldn't be able to give us 75%, but they thought they'd be able to give us 70%. And I said, you know what? I'm okay with that because at least that'll still make our returns a little bit better. I think at least at that point they're acceptable. And with the investors that we had fund this deal, I think they were actually happier because they prefer seeing lower leverage. So I said in that regard, I think at least at 70%, it'll make them happy in that regard. And then they'll still get a nice return out of it. So they'll want to invest with us.
And what was the final interest rate that you received on that loan?
3.67.
3.67. And did you still get the 1 year of IO?
Yeah.
So 1 year of IO and then 70% LTV fixed for 10 years?
We have a 12-year term and it's an assumable loan.
12-year. And what was the prepayment penalty?
So this one here is going to be yield maintenance.
Okay. Pretty standard on that. And let's walk me through the business plan. What's the business plan with this particular property? So you have the rents. You said you're trying to increase to the more market rents from the 575 to 675, more to the 750 to 800 mark. So what's the business plan to get it there?
So the business plan on this was actually fairly simple. Also something I like. So in this case, what happened is the property itself physically was in good condition. And we realized from walking through the different comps and just doing some secret shopping on them that our property had comparable interior units. So it wasn't something that we needed to go in there and start upgrading units. It was something that the previous property manager had rent significantly below where they should be. So we realized we had the opportunity to go in there and just start increasing rents pretty quickly. Now, depending on how you look at it, it could be a good or a bad thing, but being that so many rents were below where they should have been, we looked at it as a good thing. They had 27 month-to-month leases at closing. So in one way, you can look at it and say there's a lot of exposure, which is true. But the way we looked at it is, we don't want to clear the place out, obviously, because our goal is not to have occupancy dip significantly, but to do it smartly. So what we did is our first goal was to sign those 27 tenants to new leases. And we wanted to stagger their expirations. So some of them we would do it 3 months, some of them we would do it 6 months, some of them we would do it 9, and some of them at 12, just so we wouldn't have them all expiring at one time and have a real problem on our hands. So the goal with those tenants was to keep them within $75 to $100 of where they were. So we said, okay, let's get these leases signed. And we told the tenants, if they were paying $575, your new rent is going to be $675. Obviously, it doesn't make people happy, but a lot of them realized, I guess, after they were looking around that they probably had a fairly good bargain for the area and that they weren't going to find something similar for that same price. So they realized even with the $75 or $100 increase that, okay, it's either stay here, go pay more for something similar, or go out and live in something lower quality for the same or lower price. So most of them did choose to re-sign, and that worked out really well. And then with any units that became vacant, initially we had leased. So our year one plan was to get things up to 675 in year one and then 750 in year two. Now our ultimate goal was 750 because that's what we felt very confident hitting based on the comps that we saw. And we said, you know what, let's budget it based on expirations and whatnot that we'll do part of that increase in year one and part in year two. So we figured it would take 2 years to really implement. So the average rent was around $606 when we acquired the property in September. And as of today, in mid-January, it's around $687. So what we've been able to do is take new tenants and lease the units actually at $850. And initially, our property manager had told us she thought even at $750 we were under renting the units. And I have to admit, I kind of doubted her. And I said, I'd like to believe you, but I don't. I'm going to be honest. So we're going to use $750. And I'm glad that she was right and I was wrong because she's been proving me wrong and renting the units at $800 and $850. So I said, good. So in this case, we're blowing away our year one and even our year two projections.
Yeah, no, that's awesome. That's awesome. So any pushback from the residents who were on those month to months to try to get them to a actual lease, would there be 3, 6, 9, or 12 like you had mentioned? Was there any pushback from that?
Yeah, so there were definitely a few that pushed back. Some of them pushed back because of the higher rent. So in that case, we had our property manager listen to the tenants. We wanted to be reasonable and work with them, especially if they had been good tenants in the past. And some of them we made compromises with. So we said, how about if we push the rent $100, but we'll rip the carpeting up and we'll give you LVP flooring. So sometimes we would do little concessions like that. And we said, you know what, it'll ultimately benefit us anyway down the line, because now we have the LVP flooring in there. And that way, when that tenant moves out and we get somebody new, it's a lot easier on maintenance and turns. So those things worked out really well. And then there were other tenants that just didn't want to sign. There was probably 2 or 3 that left. And in that regard, it worked out really well because we released those units for $850 a piece. So instead of getting something in the $650 or $675 range, we wound up at $850. So I think it was probably best case scenario.
Mm-hmm. Any exterior budget items?
Nothing aside from deferred maintenance. So the biggest thing we did right away is we did some gutter work because we realized there were issues with standing water at the property. So that was something we addressed. Not really anything that's going to add a rental premium to it, but just something to spruce the property up so it gives it better appearance and better structural stability for the long term. We also took care of the settling with the one building that needed the 2 helical piers. So we did that right away as well. And then we added 2 amenities. We added a dog park and we also added a grilling station. So the property itself didn't have really any amenities at all prior to that. So we figured, okay, at least even though tenants are seeing the bump in rent, they'll start seeing a little something out of it. And those that have dogs or just want to go out there in the warm weather and enjoy a nice hamburger or hot dog with their friends, at least they have some way to do that and they can do it right on the property. So those were things we did pretty quickly also and got those in there.
And is this a 5-year hold play?
Correct. Yep.
Okay. And how did you end up structuring this with investors?
So this one here, we had one group that came in and funded the entire equity raise. So what happened is we did a 70-30 split and we gave them a 7% preferred return. And then from there, we just did a 70-30 split with anything after.
Okay, great. And no secondary hurdles in the waterfall or anything like that, just a straight 70-30?
Correct. Yep.
Okay. And going back to, let me ask about this group that you have that wrote the one check for the entire equity piece of it. You know, obviously I'm going to share the information publicly with who this person is for obvious reasons, but how did you end up finding and connecting with this type of person?
So we actually got them through one of our partners. So it was a relationship that he had been building for years because one of the guys that runs the group is a lifelong friend of his. And they've known each other since they were in probably middle school or maybe high school on the late side. So they've known each other probably 40 years. And our partner kept telling him, listen, you have to get out there and do something with this because he's done well for himself in different businesses and he has a lot of connections that had done well. So he told him, listen, you should be rounding these people up and getting them together so that way you can have them pool their money and invest it and then buy real estate and give them a return on it. So finally he had done that and he decided this would be his first deal, ironically, that he funded. So since then he's actually funding another deal for us right now. So I said, it's worked out very well.
Yes. Yeah. So how much was the equity raise on this deal? This
one was $1,348,000.
$1,348,000, all from one investor.
Mm-hmm.
Okay. And 70-30 split, 7% pref, 5-year hold. What's the potential on this one, seeing how well it's going for it to be able to exit sooner than the 5 years?
I would say pretty good. The one negative to it is that it isn't a tertiary market. I think right now demand is still pretty strong, but I would say that with the uncertainty in the overall market, it's hard to say. If things stay the way they are now, we don't experience any significant downturn. Realistically, I think we could probably be out in 2 to 3 years. I think we'll have the NOI of the property significantly increased by that point, and we'll probably start getting some offers, maybe some unsolicited ones. And, realistically 2 to 3 years if market conditions stay the way they are, I'd say.
What's the cap rate in this market?
So we had bought it right around the property wasn't performing as well. So we bought it at a low cap. It was somewhere in the 3 range because a lot of the rents were under where they should be performing. Mm-hmm. Now, right now in the current conditions, you could sell properties in the 6.5 cap range.
A stabilized kind of market rents property, mm-hmm. about a 6.5 cap.
Correct.
Okay. What other things can you think of that we might have not touched on yet that might have happened throughout the process during this acquisition that might be good or interesting to talk about? Anything you can think of?
No, I think we covered all the interesting points. We got all the good juicy ones.
No, that's good. That's good. Well, I have 2 final questions for you, sure. And they're kind of contrasting questions. The first one is, what did you find that was easier during this entire process that maybe originally you thought was going to be a little bit more challenging?
Surprisingly, the equity. I was not expecting that to be as easy as it was, but it worked out, being that we had a great connection there with one of our partners that was able to fund the entire thing. So I said that worked out really good.
And then the final question here is kind of the opposite of that: is what did you find that was harder than expected, that originally you thought was going to be a little bit easier? And I think I know the answer to this one.
I think you do too. It's going to be the debt. I have to admit it. I expected the debt to be the easy side and the equity to be the harder side, but they wind up kind of reversing
flip flopping.
Yeah.
Well, Charles, I want to thank you so much for spending some time with us here and sharing with our audience here on the podcast about this particular acquisition. How can the listeners reach out to you if they have further questions about this particular acquisition, or maybe even joining you on some of your future opportunities?
Sure, absolutely. So what they can do is they can reach out either by text or by email. They can text 347-306-3278, or they can send an email, Charles at 3 Oaks, the number 3, OAKSMGMT.com.
Awesome. Well, thank you again so much, Charles. I appreciate you coming on. Looking forward to continuing to follow you as you close more deals in the new year in 2021, and looking forward to having you back on the podcast.
Dan, thank you very much. Appreciate it.
Thank you so much, Charles.